Hi, good day. I'm Alphinity Investment Client Portfolio Manager at Alphinity Investment Management. Our company turned 15 this year, and today I'm joined by two of the founders who will be taking us on their journey, the lessons learned, and what's ahead for the company from here. Welcome, Andrew and Stephane. As we've just said, Alphinity turned 15 this year, and both of you have been there from the start, and you are now co-CEOs. So take us back to 2010. We literally still reeling from the global financial crisis, and the four of you decided, hey, let's start a funds management business. Take us back and tell us, why did you decide that? And more importantly, why have you stayed together over 50 years where many others don't?
The volatility at the time, while hard to navigate, actually created the opportunity.
Yeah.
It was the opportunity for us as a team to say, what do we want to do going forward? But as importantly, that volatility created the opportunity at Challenger to team up with us. So without that volatility, we wouldn't have had that opportunity, I think, to create Alphinity. So while it seemed like a strange time and there weren't too many other people setting up businesses at the time, it actually ended up being the perfect time to set up a business.
Yeah, and it came at the perfect time for us because we had worked together for many years, and we had really kind of realized that we had developed something very special. And we wanted to conserve that, preserve it, and actually grow it, but in a different structure, in a structure where it's not somebody from the US who is going to have at the head office a decision which will impact us, but where we could make the decisions. And also where we were completely aligned with our clients. Basically, our performance would kind of basically drive the business. How well we did for our clients. So what was really special that we had is a few elements. One, a very shared conviction that we had an investment process, an investment philosophy that was working and could deliver alpha consistently through time. A shared value between us. We really think the same way, and we have the same value system. But there is a very strong mutual respect and trust of each other. That's critical for the business. And actually, when we think about how well we worked well together through challenging market conditions, and also with the joy of setting up a business in parallel, which brings its own challenges,
Yes.
it's actually really these key ingredients that have been the glue of Alphinity and that we are trying to preserve today in Alphinity going forward.
Yeah, there's one thing you can hear a lot from us just around the people, how important that is. And when we started, the four of us, we knew we were like-minded, but most importantly, we were people who put others' interests before ourselves. And I think that's really important in a pressure situation like setting up business and running a business company. If you put yourself ahead of others, that makes it much more difficult. And you'll see just even in our structure, which I'm sure we'll chat about later, is set out to make sure that isn't the case.
Yes.
There was a lot of reflection actually a few years ago of thinking, what is this glue? What are the elements of the glue that we have? And we try to distill it in 3 words of the culture, which is basically team, trust, and performance. To Andrew's point, on the team side, do we have people around who put the collective first and foremost ahead of the individual? Can we have open debates? Can we really kind of think through and lift the game rather from the individual ego game?
Yeah.
The trust, you've mentioned, that's critical. We are a small team. If you don't trust each other, there's a real issue. So we have to be able to trust each other, and then we have to be able to earn the trust from the clients. That's through hard work, that's through consistency, through reliability, a lot of integrity throughout that. And then performance. Performance is key. That's the raison d'être of the business. Without that, there is no business. So are the people that we hire, do they have the same drive as us to find the next level of alpha generation, kind of Winnie, on this ongoing quest of this alpha?
It is tricky to grow because on the one hand, you want to maintain your boutique edge. On the other hand, you want to grow your business. And in your reflections note, you talk about that hungry can-do culture. So how do you make sure that that's maintained? And when you interview someone, how do you know those 3 values that you mentioned are actually going to be embraced by this person rather than just said it is?
I think it's really important, as Stephane mentioned, that having that that sort of team culture, that flat team culture, I guess, keeps everyone grounded.
Yeah.
You know, we want to make sure from the so the youngest person to the oldest person, everyone has a voice, right? So everyone's heard and has influence. It's amazing how empowering it is to make sure that everyone feels that they actually have influence in saying what's going on.
Yeah.
It's really easy as you grow a business and get bigger and bigger to have that hierarchical structure where, you know, I'm the head and someone's below here and there. You try to take that out entirely. In fact, we spend a lot of time trying not to be a big business, which is difficult. But I think giving people that sort of freedom within boundaries to actually go out and express themselves and create and actually get stuff done and see the evidence of what they're doing come through and get rewarded, I think is really important to keep that culture, that hungry can-do culture, or that we're all in this together top culture for us.
Yeah, we spend a lot of time in the interview process actually retesting these three aspects through individual interviews, through a team setting where we ask the person to kind of go through a case. That's the level of preparation for the case is interesting in itself.
Yeah.
The way that the person will debate with the team and be open to questions is interesting in itself.
I think Johan used to say, that was a really good point. He used to say, you know, that what the culture we want is people who play the issue, not the person. And again, it's quite hard to find those people, but going through that process that Stephane was talking about brings out, you can see that the people that want to really delve into an issue and not get offended by someone who actually challenges them, because we need to challenge each other in this job. That's what we need to do.
Yes, of course.
But challenge the issue, not the person, and have people who don't see it as being challenged personally, but actually, oh, that's a good question. I want to get to the bottom of what the answer to that is. And that's what we're trying to find, those top people.
You talk about investing in earnings leadership. Can you tell us what that means practically? And then also importantly, you mentioned that you've never strayed from that process and philosophy over 15 years. How did you maintain that discipline through all that time when we know the markets have been through a lot of chaos?
So earnings leadership, let's just start there. So earnings leadership, as it sounds like, it's all about earnings. So we've got a strong view that earnings drive share prices. And actually, it's not a controversial statement at all. People forget about it and they approach investing from lots of different angles. But really, it all comes down to earnings, right? Yeah. Things like what the market is. The market is a collection of companies who have earnings, and those earnings get valued, and that's the share market. So it's obvious to us that you should focus on earnings. And we can show you lots of empirical evidence as to why that's the case. That drives share prices. What drives alpha, so performance above share prices, what matters is actually the change in expectations around those earnings. The market's really good at pricing in pretty quickly, especially these days, current changes in earnings expectations. It's really poor at factoring in what that means about tomorrow, the next day, and what's going to happen to earnings in a year's time. And that's where the alpha gets captured. And we see it time and time again. And the reason we have the Weybird is we've been through a whole range of stuff in the last 25 years with this process. And it always comes back to earnings, as it should, because it's logical, it's intuitive, it's empirical, we can see it. And so, you know, you often get pulled in lots of different directions in particularly times of crisis where things have changed, the world's different. And it's amazing how, you know, if you're patient and you stick to your process, it always comes back to it. And so that's why we focus on earnings leadership, and why we don't deviate, because it works and it continues to work.
And the second bond aspect is that earnings are serially correlated. So it's not only the earnings and the change of earnings which drive the alpha, but it's that there is a serial correlation of the earnings. And we all know that from our personal experience. You build a house, it takes a bit longer to build a house. You think you'll get it in cost, and then eventually it costs a bit more, takes a bit longer. It's human behavior, basically, human psychology. And so that's basically happens on the way down. When project goes badly, the company becomes too optimistic on how quickly they'll be able to fix it. And also on the way up, when things are going well, stay a bit conservative, don't kind of want to overpromise.
Yes.
And then the market catches up. And that's the opportunity for us because of that serial correlation. But if you come in and you have the positive earnings surprise, and you can see that there's the next one, which is also going to be a positive earnings surprise, your risk reward is far more attractive, and that trend lasts, and you can kind of generate quite meaningful alpha over time by staying on that trend.
So one of the other factors that you talk about is value, and I did see in your note you said that value really tells you when to buy a stock or when to sell a stock. So it's a pretty provocative statement.
Anyone thinks that they can accurately to the dollar and cents value a company at any one point, that they're dreaming, frankly. It's just too many unknowns. So things change all the time. I give the example that every great company at some point in their journey was considered massively expensive, and it wasn't massively expensive. That people just got the earnings wrong.
Yeah.
Right, so that's the differential. So our view is, look, you of course you can have a view on a development valuation. You can have an understanding that something is expensive. You can have an understanding something looks cheap, but that doesn't tell you should be buying or selling it. It's a fantastic risk measure letter. It tells you that, let's say something is expensive notionally. It just tells you that when something goes wrong, it always goes wrong for a company. When it goes wrong and it's expensive, the reaction to the share price is going to be big. If something's cheap and eventually something goes right, the reaction the other way is going to be pretty positive.
Yeah.
The more expensive or the more cheap it is, the bigger the reaction, and therefore you use that as a risk control, and you measure your positions accordingly. And eventually you get to a point where it's so extreme, you say, well, I just can't take that risk, and so yes, maybe you sell at that point. But if you sell this exact point, I've valued it at $10, I'm going to sell here, you just give up a lot of money over time, frankly. So use it as a risk tool.
So if we talk a bit about process and how you find these earnings leaders, where we are a bit different at Alphinity is that we combine human analysts with quantitative models, when the rest of the market probably prefers to do one or the other. So can you explain to us exactly how do you bring those two together, and then also the fact that you have been using it for 15 years and you haven't changed it? That's, again, a lot of discipline being deployed. So how do you find those stocks, and what happens when the analyst says one thing and the quant says something else?
So first, quant is a tool for the analyst. That's a very important thing. And it's not a black box. There are factors, there are signals in the market which tell you if a stock is more likely to surprise positively or not. And these are the 6 factors that we are using, some momentum factors and some quality factors. The power of the whole process is when these objective factors, which cannot be manipulated by the analyst, tell you this company is likely to surprise positively, and that the analyst research says the same thing, that's when you know that you are in the sweet spot where the risk reward is actually the most attractive and your information ratio can be actually quite high. So that's, and the quants are really kind of a signal which we can debate openly if they come negative or positive. They tell us something about the market, and it's part of the discussion.
Yeah.
I mean, the whole point for us is that quant isn't supposed to pick stocks for us. It's not supposed to be difficult. They're supposed to be meaningful, but not difficult. And the reason I say that is because often people have had this idea of quant as being sort of black box that people don't really understand, but it shoots out something and should buy a stock. Our view is the opposite. Is as Stephane said, it's a tool for the analysts. It's a tool for the portfolio managers. It's for us, it's the same as any other part of research. It's just upon a spectrum. And so to your point, what happens when a quant and fundamental disagree all the time? Our answer to that is do more research. Find some more information. Everything needs to be resolved via research, not guessing, not saying, okay, well, we'll go with quant this time, or we'll go with you. It's, let's resolve that. But the quant is saying this, and because it is reasonably simple quant, which we want by design, we can understand, okay, it's saying that earnings are going down. Why are they going down? Well, you're telling me that things are improving.
Yeah.
And then you have to explain if the quant is poor and that you think that you're going to have positive earnings revision, you have to explain why you think things are different, and then debate that with the team, and then can take a position if we think as collectively that actually it makes sense. But you take it in a risk-adjusted manner, because the risk is higher to actually go against the quant than when the quant and the research tells you the same thing. Then you can kind of actually take a bigger position. In the same way, when the quants are strong, but they're deciding to deteriorate, but the analyst's conviction stays in, that is also a signal for the PM of saying something is changing here. The risk is increasing. Do we need to kind of temper our position, reduce our position?
Yeah. And by the way, we do, while we haven't changed our process in 20-something years, we test it all the time. If we go back and test it, are these factors still making sense? Is the world changing? And the reality is our factors are set up for the real world. So they're not set up for some, strange quant reason. They're actually set up for, actually, this is what happens in a company. These quant factors point to what's happening in a company. And unless companies massively change their function, which I don't think is going to happen, they should still work. But we go and test them all the time to make sure.
So if we talk about outcomes, the main objective at Alphinity that we always say is that we want to deliver consistent performance for clients through various different market cycles. The notion of delivering a little bit of alpha or outperformance more often. That sounds pretty modest, but when you compound it over many years, it does become very powerful. Can you tell us, how do you find those? And is that the outcome that you want for clients?
Yeah, I mean, for us, firstly, it really fits our risk profile. We're pretty conservative. It also fits the way we think about risk, right? So we're all taught that you have to take risk to get a return. That's absolutely true. Where we are a bit different, I think, is that our view is you don't have to take risk all the time to make a return. Take lots of risk at the right time. And so that's what we design our processes to make sure that when we're on risk, it's about taking risk when we've got the highest probability being correct. And that just takes out a lot of risk along the way. And that fits into our sort of style agnostic process, right? So if you're a particular style investor, that's just completely fine. You can make a lot of alpha, but you have to make a lot of alpha in short periods of time, right? Because you know that your style is not going to be in favor over long periods of time. It'll be in short periods of time. To do that, you have to take lots of risk. Because you've got a short period of time, you take lots of risk. And by the way, you never quite know when your style is going to be there, so you have to kind of be on risk all the time. Our view is, well, we don't really care what style it is. It's about earnings, and therefore you actually don't have to take as much risk all the time, and therefore you can be lower risk, but you don't actually give up alpha over time. In fact, you're just much more consistent. And we think, from a client perspective, we actually think that's the best outcome. Everyone says, yes, but I'm investing for the long term. That's true, but your long term is different to my long term, different to Stephane's long term. Someone's long term finishes tomorrow. So from a sequencing risk point of view, the more consistent you can be with performance, ultimately, the better. And so, that's the way we approach it. We think it's ultimately appreciated by clients, and we just have a lot less volatility at what we do. Now, it's not easy, that it is difficult to do, but we think the reason we focus on earnings is because earnings is just much more consistent than most other factors in the market.
And if we reflect back over the 15 years, when we've been through the global financial crisis, we've been through the COVID pandemic, we've been through many interest rate hiking and declining cycles, we've been through many commodity cycles. What are some of the key lessons that you've learned during this period of chaos? At any point in time, there's always something that happens in markets.
Yeah, I think there are quite a few lessons for us. I mean, the first one is that our philosophy of earnings revision drive share prices and earnings are serially correlated has been proven over the last 15 to 20 years that we've worked together. And it's very important. And it also tells us that don't try to pick the inflection points. Wait, actually, be really patient, wait for the inflection point to be proven to actually then start kind of looking at the stock and investing in it. You can be, if you try to pick the inflection point, you can be in a value trap for a long time. And that can be very painful performance-wise. These earnings revisions can last much longer than you think, and on the upside as well as on the downside. So really kind of waiting for these inflection points is an important aspect.
There's probably been 5 or 6 attempted major rotations just in the last 12 months. As we get towards the end of the year, there's one rotation that's starting to stick because actually there's evidence that earnings are turning in that particular sector. The last 5, there wasn't, and so things rotated back. So if you're trying to pick turning points or reacting to stuff, you just got to be more wrong than right. But if you actually just wait for some evidence, be patient, because you know that once the trend turns, trends just go on for much longer than people think, both ways. So just because you missed the first 10%, you haven't missed it. You've just missed the other 5 attempted rotations as well. So you're actually still ahead. Yes. Now you can get the trend on the other side.
So it's that aspect. I think another point is ESG. Quite a few people take it as a tick the box exercise. And actually this year, we've seen many examples of companies where the share price has collapsed because of poor governance. So poor governance or losing the social license to operate can have a significant impact on the share price. It's not only a ticking the box exercise, it's making sure that you're investing in a quality that is well matched.
So you both have been doing this for a very long time, across various different companies.
You was so young.
And yet you still look so young. What keeps you excited about picking stocks and running your company?
I mean, from a stock market perspective, that what I would say is that every day is different, right? It really is. It's
Yes.
exciting and sometimes stressful, but every day is different. And the market teaches you a lot all the time, right? As soon as you think, frankly, that you've got it all figured out, it probably means you're about to be whacked on the head by the market. Just wait a day, things change. So it's a challenge, and it's an exciting challenge to see what's going to happen. The other thing I really enjoy about it is not too many jobs in this world where you get to interact daily with some of the greatest companies in the world, some of the greatest business people in the world. You're at the sort of bleeding edge of what's happening in the economy and politics and everything that's going on in the world. And you're doing this daily, so you're right in the mix of what's going on, economically, politically in the world. And I think I find that really exciting, and then trying to convey that into, well, how do I make investment returns from my clients from all this noise? What are the bits of information I need to pull to do that? So I find that that part of the job really exciting.
Yeah, I can really echo that. But also, I think the environment we have created, we've hired really smart people, incredibly talented people, and people where we have shared values. This whole aspect of team, collective, it resonates within Alphinity, and it makes it a really pleasurable environment a motivating environment to work in. So that's really part of it, that you work with people that you enjoy working with.
Yes.
I think another aspect for me which excites me beyond the pure investment side of it is still the ESG side of it. I think that we have an ability to influence management in the way that they manage the companies, look after their supply chain in terms of the modern slavery risk, there's decarbonization, making sure that they manage the climate risk in a responsible way, that they look at the psychological and physical safety of their employees, that they have the right governance. All these aspects are lifting the game of how companies are managed, and therefore how society is run. So we think that that's kind of like another kind of positive angle.
Okay, so my last question to you both. When you think ahead, what would you like Alphinity's legacy to be? Besides returns for clients, what would you want people to say, oh, they got that right?
To me, I'd love people to think about Alphinity, and I hope they think about it now as, a group of decent, ethical people that are constantly trying to do the right thing for clients. It's in our name, Alphinity. That sort of constant, rigorous pursuit of performance, and I'd add on that, doing it in a sort of decent, ethical.
Shared values. Obviously, then we kind of we would have that in common. I also think that I'd like Alphinity to be kind of known for its influence on lifting the game on the ESG for companies, that we actually kind of help companies to think through what the other companies in the world are doing in different areas of supply chain and so on, and that it actually kind of makes them think how to improve and to be a better corporate for the citizens, particularly.
Well, thank you, Andrew and Stephane, and thank you very much to all our clients, the rest of the Alphinity team, as well as Vedanta, our partner, for all the trust and support over the last 50 years. And we look forward to seeing what's ahead for Alphinity and where we can all go together. Thank you.